Welcome to The Explainer. Today, we're unpacking a massive financial detective story, and honestly, it's one that directly impacts your future. When we really start looking at the data, it becomes pretty clear that we might be living through one of the biggest market bubbles in history. And the wildest part? In the coming weeks and months, your retirement account, your 401k, is about to be used to automatically buy shares in some of the largest IPOs in human history. And that's going to happen even if you have absolutely no idea it's going on. So let's dive into this and figure out exactly how this is happening right under our noses.
So we really have to ask, is your hard-earned 401k funding the biggest exit strategy in history? Today we're going to uncover how the actual financial plumbing of our markets is being completely rewired to accommodate an absolutely unprecedented exit for tech insiders. And look, this isn't just theory or speculation. We are tracking the actual rule changes and the real capital flows.
Here's our roadmap for today. We're going to start with rewriting market rules, then move to selling the trillion-dollar dream, uncover the AI money illusion, examine the macro ticking clock, and finally talk about when history rhymes.
All right, Section 1, rewriting the market rules and how the Nasdaq completely changed the game. To unravel this whole mystery, we first have to understand that to find enough buyers for literally trillions of dollars in stock, the financial system had to rewrite its own rulebook. It's crazy. Under the old Nasdaq rules, a company needed a minimum 10% public float, meaning 10% of its shares actually had to be available to the public. Plus, they had to wait up to a full year just to be included in major indexes. But the new fast entry rules that hit on May 1st, they changed everything. They slashed that waiting period to just 15 trading days. They dropped the float requirement, allowing companies with just a tiny 4% float to qualify. And here's the kicker. There's a hidden 3x multiplier. This means if a company lists with a 4% float, the index treats it as a 12% float. This setup brilliantly forces passive index funds, like the one sitting in your 401k right now, to artificially inflate their buying at these upcoming tech IPOs, automatically absorbing huge amounts of stock. $4 trillion. Just let that sink in for a second. That massive number represents the combined potential valuation of just 3 companies, SpaceX, OpenAI, and Anthropic, and they are all lining up for public listings. By rewriting the rules, the system practically guarantees that massive automatic demand from passive retirement accounts is just sitting there, waiting to catch this $4 trillion wave of newly issued stock.
Which brings us to Section 2, selling the dream and what you are actually buying.
Let's look at the specific companies involved here, starting with the first one in line, SpaceX. What are you actually getting for a staggering $1.75 trillion valuation? Well, you aren't just buying one unified company. You're essentially buying 3 distinct businesses all bundled together. On one side, you have the rocket business, pulling in $4 billion in revenue. Then there's Starlink, a highly profitable operation doing $11.4 billion. But bundled right inside that is xAI. And xAI is essentially a financial bonfire, literally burning through $1 billion a month. And that brings us to this number, $5 billion. That is the total loss SpaceX took last year as a combined entity. I mean, really think about that. You are being asked to automatically buy into a massive $1.75 trillion IPO valuation for a company that just lost $5 billion. This stark contrast shows exactly why they need everyday retirement accounts to buy into the dream of AI. The financial fundamentals just do not support the valuation unless there's an absolutely epic story attached to it.
Moving on to Section 3, the AI money illusion, and a little something called the Pokemon card accounting trick.
So why are all these massive tech companies rushing to go public right now? Well, it points to a massive paper illusion that's kind of holding the entire tech sector together. Think of it like a Pokemon card trade. Imagine I lend you $100 so you can buy a Pokemon card from me. I then write down on my books that I made a profit. And then I use that paper profit to justify lending you even more money. That's essentially what's happening here in this giant circular capital expenditure loop. Step 1, big tech invest billions into an AI startup. Step 2, that AI startup immediately uses that exact same money to rent computing power and servers right back from the big tech company. Step 3, big tech logs that money coming back in as revenue. They are literally just passing money back and forth to artificially inflate their profits on paper.
And data from the Financial Times shows exactly how this plays out. Analysts looked at the projected implied returns for these tech giants on their massive AI infrastructure builds. And guys, even under the most generous best-case scenarios, assuming literally 0 overhead costs, no electricity, no salaries, almost all of them are projected to lose money. Microsoft manages a 9.2% return, and Amazon squeaks out 7.2%. But look at the rest. Google is at negative 15.7%, Meta at negative 28.8%, and Oracle at a whopping negative 35.6%. The math underneath this entire boom just does not add up.
Want to know the most shocking part of that circular loop? Roughly half of the entire revenue backlog for these massive tech titans comes directly from the exact same AI startups they just handed billions of dollars to. Microsoft backlog is 54% reliant on this. Oracle and Amazon are sitting at 51%. The money is literally just spinning in a circle.
Which brings us to a major plot twist. We aren't necessarily in a valuation bubble like we saw in the dot-com era, where companies with zero earnings traded at insane multiples. Instead, we are likely in an earnings bubble. This is a condition where valuations, like the price-to-earnings ratio, actually appear somewhat reasonable on the surface, but they're hiding in plain sight because the earnings themselves, are artificially inflated by that circular Pokemon card accounting trick we just talked about.
All right, Section 4, the macro ticking clock. Why the huge rush to IPO? Why the massive rush to IPO right this second? It's because insiders feel an intense urgency to validate these paper profits before the global macroeconomic system starts breaking down. Remember, the passive investment money these IPOs completely rely on only exists if everyday Americans actually have healthy paychecks to funnel into their 401ks every 2 weeks. But that reality is rapidly deteriorating. The U.S. personal savings rate just hit 2.6%. That's the lowest it's been in 4 years. Meanwhile, real wages are completely flat. Ironically, as AI automation widens the wealth gap, it actively squeezes the very middle-class consumer whose retirement savings are required to buy these newly issued shares.
Plus, there is a global ticking clock threatening to pop this debt-funded AI spending boom. Geopolitical conflicts have kept the Strait of Hormuz closed for months, and oil inventories are reaching critically low levels worldwide. Experts are warning of a potential spike to $150 or even $160 per barrel of oil. Now, if oil prices skyrocket, countries will be forced to dump their U.S. treasuries to get the dollars they need to buy that expensive oil. And when treasuries are dumped, interest rates drive up, corporate borrowing gets vastly more expensive, and that entirely debt-fueled circular AI spending loop comes under immense, crushing pressure.
Which brings us to this really profound quote from a researcher. At the limit, firms automate their way to boundless productivity and zero demand. This summarizes the ultimate tragic irony of this entire situation. The AI boom is actively destroying the very consumer wages that are required to fund the 401ks and retirement accounts that these massive tech companies desperately need for their exit liquidity.
Finally, Section 5, when history rhymes, the pattern of tech booms. Is this situation entirely unprecedented? Well, not quite. If we look at past market behaviors, we can track these historical rhymes. In the 1800s, we had the railroad boom. In the 1990s, the fiber optic boom. And today, the AI boom. In both previous eras, incredibly revolutionary infrastructure was built that genuinely changed the world. But the original companies that built it went bankrupt, and the initial investors lost absolutely everything.
And that right there is the absolutely crucial takeaway you need to remember. The technology wins, but the initial investors lose. Look, AI is absolutely real, it's transformative, and it's for sure going to shape our future. But being forced to buy into it at multi-trillion-dollar valuations at the absolute peak of the hype cycle, historically, that is a disastrous financial move.
Just look at these legendary companies: Xerox, Ford, McDonald's, Apple. These are absolute giants today. But they all had their initial public offering, their IPO, which is the very first time a company sells its shares to the public, at the exact moment of maximum public hype. And historically, that public hype coincided perfectly with the stock market peaking right afterward. An IPO is rarely about a company desperately needing cash. It's almost always about an early seller desperately needing a buyer.
So who actually benefits here? Well, the winners are the technology itself, and the secondary investors who swoop in years later to buy the distressed assets at pennies on the dollar to build the future. The losers? That would be the everyday retail investors and the passive funds, like your 401k, who are forced by rewritten index rules to absorb the initial massive losses of the early hype cycle. That is the grim reality of the 401k exit strategy.
So I'll leave you with this provocative thought to ponder. Is your passive retirement fund about to become active exit liquidity for Silicon Valley insiders? It is definitely time to review exactly what your index funds actually own, understand the rules of the game being played, and take an active role in protecting your own portfolio, because if history is any guide, the system is banking on you not paying attention. Keep learning, keep questioning, and I'll see you in the next explainer.